Hello everyone. Today we are going to illustrate the saying, be careful what you wish for because you might get it. And we're going to use inflation to do so. So for many years, markets wondered, even worried about its absence. A decade of unconventional monetary policy and negative interest rates should have pushed price higher. But that was not the case until recently. The exit of the pandemic and the war in Ukraine revived inflation that was so to have disappeared forever. A measured return could have been a good news, but now it is coming too fast, too strong, and it's causing a new headache for central banks. And while the Fed has started its monetary tightening cycle, the situation is less clear on this side of the Atlantic. One thing is clear, however, for the markets, the return of the euro benchmark rate to positive territory this year. It will be a first time in almost 10 years. These monetary tightenings, whether real or anticipated, have had a significant impact on bond markets, which have made their worst start of a year. Beyond the performances, it is interesting to observe this phenomenon through the evolution of the stock of negative yielding debt. While it reached $1.5 trillion last summer for corporate bonds, it fell to zero on April 25. The yield to maturity of the Bloomberg Corporate Bond Index even rose above 4% for the first time since January 2019, if we exclude the March 2020 peak. This provides the first entry points to return to the bond market, while keeping a few cautious tips in mind. The first one is to take advantage of this rise in yield to improve the quality of the bonds held. Because in times of economic downturn, the less financially solid companies suffer more and see their risk premiums widen. Remember also that the shorter the life of a bond, the less sensitive it is to change in bond yields. And the impact of this is twofold. It is a matter of ensuring that one does not buy maturities that are too long, but also of favoring bonds with a higher coupon because for the same maturity, their duration is shorter and therefore more defensive. While the ECB has not yet started to raise rates, bond yields are already incorporating these movements. The German 10-year yield has risen from minus 0.18 to plus 0.8% this year, while the 2-year yield went from minus 0.62 to plus 0.1%. And while these figures may seem close or even negligible, the impact on the performance is clear. This translates into a fall of minus 1.2% in a price of a 2-year bond and minus 8.5% for a 10-year maturity, a perfect illustration of the duration effect. The year will be complicated and will require both central banks and investors to play it tight between the devil of rising inflation and the deep sea of slowing growth. Thank you.